What's up guys, it's the Urban Trader back again with another video. And in this week's video, I want to help you all to develop an outlook for the week of June 23rd through June 28th based upon the events of last week. And in order to do that, I want to talk about 5 key principles. Let's talk stocks the Urban Trader's way. First I'd like to talk about is the Fed's hawkish pause, which caused markets to become on edge. The Fed held interest rates steady, but stressed that inflation risks remain elevated. Chair Powell's tone signaled more caution, leaving room for further hikes or delayed rate cuts. What I believe that means for the next week is that we can expect investors to have a sensitivity to heightened market data, especially inflation and employment data. Investors may brace for PCE inflation reports, which come out on Friday, June 28th, and are a key metric to the Fed's policy. We also may see more hawkish language from the Fed, which could limit tech and growth stock rallies, favoring value and defensive names. The second item that I want to talk to y'all about is the Middle East risk premium, oil volatility, which is likely to continue. Last week, markets swung as Israel and Iran tensions cooled, then flared again. Oil briefly fell early in the week, but bounced midweek and dragged indexes lower on Friday. I think that with some of the tensions that pursued on Friday evening with some of the Iran missile site bombings, that oil prices will go higher. I think this week we can expect oil to go greater than $85 a barrel, pressuring airline, transportation, and consumer stocks. I think that we need to watch for possible U.S. diplomatic responses on global shipping disruptions. And I think we need to pay close attention to energy stocks, which could benefit again from geopolitical risk increases. The third item that I'd like to talk about are U.S. tariff drags that affect consumer and growth risk. As I talked about in my video from last week, there was about $200 billion in trade deficit that was recognized in the second quarter of this year, April, May, and June, even though June's not over just yet. This is mainly because the tariff price has driven inflation weaker and trade flows are starting to show up in some macro conditions. What we're starting to see is that the consumer isn't as strong, and that's showing up in retail and consumer discretionary stocks, which we are starting to see some pressure in. I think that we're going to start to see companies issue some forward guidance as it relates to tariffs when we get into the end of July and August, and we may even start to see politicians become very combative over economic impacts. The fourth item I'd like to talk to you all about is the LEI decline and what that means for stagnant growth. This week, the U.S. leading economic index fell again in May, its second straight decline, pointing to potential economic deceleration ahead. What that means for the coming week is that we need to watch for durable goods orders and consumer confidence reports. We need to be aware of sectors like auto and housing, which could react sharply to these reports, and this may even push the Fed to be more dovish in the third quarter if we see any weakness in these reports. Lastly, I'd like to talk to you about the global risks that are rising with Russia, UK, and the Eurozone crosswinds. This week we saw Vladimir Putin vow that Russia would avoid a recession at all costs, despite having 10% inflation and 21% interest rates. The Bank of England held rates while warning of elevated uncertainty. What I think that this means for the coming week is that there may be some Russia-related sanctions or commodity moves may continue to affect global energy prices. I think the Eurozone and UK inflation data due next week will shape the ECB and Bank of England tone, and I believe that global investors may shift focus back to currency volatility and bond yields. Although the market is in chaos, I do believe that there are some trends we need to watch for in certain sectors. I think that as Fed policy becomes unclear, that we need to watch for the financial and banking sectors, that as Fed rates become unchanged, banks will remain flat. I think that as Fed rates remain unchanged, we need to watch out for utilities and home builders. As geopolitics continue to increase, oil and energy stocks will continue to rise, and risk on and risk off cycles will continue to advance. There will be issues with the transportation and auto cycle. Defense stocks will always be on the rise in war times, and we need to stay on the lookout for tech and consumer staples as they are very inflationary. There could be pressure on U.S. retailers, because the consumer is not as strong currently, and industrials could be hit very hard due to the increase in the cost of raw goods and materials. There are a few stocks that we need to watch out for specifically. I think that we need to be on the lookout this week for stocks like Palantir, Altria Group, Walmart, Caterpillar, and Deere. These are just a couple of the names. If you look at sectors such as energy, commodities, utilities, and healthcare, I think that you will find many names that are well suited to make a lot of money during these times. I appreciate you guys for looking at another video. Catch you in the next one.